directly start with the IPO video review. Okay, so I request that you should not be putting more and more chats in the chat box. Just focus on the entire presentation right now. What we will do is next 10-15 minutes just try and concentrate on the presentation. After the presentation is over, then I will take quick question and answers from your side. So a small request from my side is that don't send chats while I'm presenting. So that will be great. It will be easier for everyone to focus, right? So let's start right away. First of all, let us understand what does the company do. I'll just share my screen as well, so that for important slides I'll share my screen so that it will be easy for you to visualize some key data points. We are talking about Home First Finance Company, and the company is basically like an NBFC only. NBFC is a non-banking financial company or a non-banking financial corporation, but it comes into the HFC space. So HFC means what? Home Finance Company. So let me quickly simplify this for you. A non-banking finance company can give loans, but loans for what? Can it give a vehicle loan? Yes. Can it give a home loan? Yes. Can it give a personal loan? Yes. But a non-banking financial company which focuses only on home loans, okay, special focus only and only on home loans, that will be like a HFC, a home finance company. And the company that we are discussing today, Home First Finance Company, that is the HFC, Home Finance Company, right? So now in the HFC space, further if I divide, in HFC space also there are companies, different types of NBFCs, and this comes in the Affordable Home Finance Company. Okay, so I hope you have understood this. NBFC is a wider term. In NBFCs you can have multiple types of NBFCs. One of the type is home finance. In home finance there could be types, in which we are talking about one type, which is affordable home finance. Okay, now what is this affordable home finance? These NBFCs, these housing finance companies, will give loans up to 25 lakh rupees only. Okay, so this NBFC will not give loan of, let us say, 50 lakhs, 1 crore to a single person. Maximum, we call this as a ticket size. Okay, the word is ticket size. The ticket size, that is nothing but the loan amount. Maximum loan amount to a single person will be 25 lakhs, that is nothing but 2.5 millions. Well, the company started its operations in August 2010, and their target customers are generally people who are like the first time home buyers and who are from the low or middle income group. Now you might be wondering, why are they targeting low and middle income group people? For an obvious reason, that their ticket size is anyways up to maximum 25 lakhs. So if the loan amount is going to be maximum 25 lakhs only, then the house value is also going to be pretty less, somewhere around 30-35 lakhs, let us say. In that scenario, the target base matches with the house value, which is a low and middle income group target. If I talk about the average loan, I know that as per law they are allowed to give loans worth rupees 25 lakhs, but on an average company gives a loan of 5 lakh rupees to 20 lakh rupees for a person. Okay, so now going back to the scenario, if you remember, I told you that a housing finance company also can have subtypes. So which subtype is HFC into? It is into affordable housing finance. But could there be another category? Another category is nothing but normal housing finance. So obviously what will be normal housing finance? Let me see if you are paying attention or not. For an affordable housing finance company, there is a limit that you can't give loan more than 25 lakhs. So what will be a normal housing finance company? Obviously it will be a company which will be giving loan over and above 25 lakhs. Okay, I hope you have understood the difference between a normal finance company and a normal housing company and an affordable housing loan company. Okay, so moving on, let's start with the industry analysis, and for that I will share my screen with you so that it becomes easier for you to visualize what I am trying to tell you. Okay, industry analysis. Now here you can see that we of course got this from the red herring prospectus only, that India's mortgage to GDP ratio. Okay, so how many people, mortgage is nothing but like home loan. Okay, simple words, mortgage is equal to home loan. India's mortgage to GDP ratio is only 12.4%. Okay, but in developed countries like USA and UK, it's 62%, 67%. Means what? In India, still people having their own house, taking a loan for buying your own house, that ratio is comparatively less. Okay, so do we have more scope in India? Answer is obviously yes, because as I mentioned that the mortgage to GDP ratio is as low as 12.4%, right? If I go to the housing loan industry size definitely is increasing, no doubt about that. But if I'm talking about the growth in the loan size. So growth in loan disbursements, how many loans were given, the rate at which it was increasing. It was at 15% in FY15, went up to 20, then 16, 16, 15. But then you can see it has dropped quite sharply, and the expected for FY21, that is a projected for FY21, can be as low as 5 to 6%. So can I say there is a decline, a clear-cut decline in what? Housing loan disbursements. Okay, so the rate at which loans grew, the rate at which housing loan disbursement grew, that rate is coming down. The rate at which disbursements were given have come down from 20% to roughly 5-6%, which is the projected figure. But after FY20, it is projected, this is a report by CRISIL projects that the CAGR will improve in the coming years, and it will improve to 8 to 9%. Okay, now if I'm talking about housing finance companies, the breakup of housing finance companies versus banks. So what does this mean now? Let us say total number of home loans given. Now who can give a home loan? Either a housing finance company can give a home loan, or a bank can also give a home loan. Simple example of housing finance company can be HDFC also. HDFC is not a bank. HDFC is a housing finance company. But if I talk about HDFC Bank, so obviously it's a bank, na? So absolute beginners, those who are absolute beginners in the stock market, for you this is a important information. HDFC is different and HDFC Bank is different. HDFC, normal HDFC is NBFC, and HDFC Bank, of course, as the name suggests, it's a bank. So out of 100 loans given, I can say majority of the loans are disbursed by banks only. Orange are in banks. Above 60% loans are being disbursed by banks, and roughly around 39-40% of the loans are given by housing finance companies, by NBFCs. So again, there's a chance, there's a potential for housing finance companies to grow, right? So if I come to company analysis now, out of the total loans given, whatever loan amount the company disburses, 92.1% of the total loans are given for housing loans, are given as housing loans. Okay, then what about balance? It's a housing finance company. Out of 100, 92% are given as housing loans. What about the balance? Balance loan is given as loan against property, or loan can be even given to developers or others. Okay, so this is of course a very small point, but I think majority 92% comes from home loans only. Now this was revenue mix. Okay, but if I talk about customer mix, who is their customers? It's an important point again. Salaried customers account for 73.1% of the gross loan assets, and self-employed customers account for only 25%. Okay, so where do you think the risk is higher? I'm going to ask you a question quickly. I'm going to check the answer in the comment box. I want you to tell me, if you are a banker, if you are a NBFC, then what do you feel? Chances of default are higher in salaried, or chances of default are higher in self-employed? It's a very logical answer. Let me see if you can give the answer correctly. I'm again repeating the question. Where do you feel that chances of default could be a little bit higher, for self-employed or for salaried people? Yes, 2-3 people have already given a quick and correct answer. So self-employed, obviously the risk is definitely higher. Why? Because for a self-employed person, the revenue stream can go up and down. It's not, the revenues are not fixed. Okay, so is it a positive point for the company? So answer is again yes, it's a positive sign that majority of their customers are salaried customers. 73% are salaried customers. If I go to the customer base, digging down into details, so if you can see our same point, salaried people are accounting for 74% and self-employed are accounting for 25%. But there is one more very interesting point here. New to credit loan accounts account for roughly 40% as at 30th September 2020. Now what is this new to credit loan? So I'll quickly tell you what is new to credit loan. It means that those people who have never ever taken a loan. Okay, so is the risk a little bit higher? Yes. Why? Because these people are people who are taking the loan for the first time. It means that they don't have enough credit history. Their CIBIL score will also not be able to reflect a lot of information about that person. Okay, so if you are giving loan to people who are taking the loan for the very first time, I can surely say that the risk is a shade higher than the normal risk. Okay, and for this company, 40% of their loans are disbursed to people who are newbies or are the first timers to borrow amount to take a loan, right? They have also reflected one. They have also mentioned one more point in their prospectus, which is that they have developed a good app or some good technology, I can say, wherein disbursement of loan becomes very easy, seamless, I can say, so that these people who are, because see, 75% of their people are salaried people, so and so these people might not be in a position to take a leave every single time and rush to the bank to complete the banking formalities for loan. So what the company has done is that they have taken this process as an online process. So automatically what will happen? Automatically the process at which loan will be the time within which loan will be processed and disbursed, that time limit will be less because of technology involvement, right? So that's one more point. Well, if I talk about the branch network now, it's very clearly evident that Gujarat, Maharashtra, Tamil Nadu, Karnataka, all these are having, why even Karnataka? I can say only top 3 also. Top 3 are like Gujarat, Maharashtra, Tamil Nadu. If I say 39%, 21%, 16, 70%, 70 odd percent only by top 3, and even if I consider Karnataka also, this is also 9.3%. So that is amounting to almost 80% of the business share, and that is why I can say there's a kind of a concentration risk state wise. Okay, it's not a heavy risk as such, but top 4 states are accounting for almost 80% of their business, right? So this is about the company as such. If I go a little bit into the financials now, these are certain requirements for the financials. There is something known as a capital adequacy ratio. For those who don't know what is capital adequacy ratio, I have also done a small Instagram reel on what is capital adequacy ratio. Maybe I posted that as a YouTube short as well. In simple words, what is capital adequacy ratio? How much capital the company must have in comparison to their risk weighted assets. Okay, I know this is a bit difficult to digest. I can, for simplicity, I will substitute risk weighted assets with loan. Okay, so let's assume this, that if loan amount is 100, loans disbursed by the bank is 100, how much capital they should have? So there's a ratio here, right? Capital is to loans disbursed, but instead of saying loans, we say risk weighted assets. Of course, there's a formula which is applied to this loans. We are not going to go into that details. So it's as good as capital is to loans. How much percentage that should be? So as per the HFC guidelines, the current percentage is 13% should be their capital adequacy ratio, which should be in the tier 1 and tier 2 capital. So that is the guideline. Minimum 13% they should have. Let's see how much capital adequacy ratio is there for the company. If you check out on this slide as well, they have, as at 30th September 2020, it is 51.8. Okay, chalo, let me again ask you a question. I'm going to check the answer in the comments box. What am I saying? As per law, their capital adequacy ratio should be 13%. Okay, but they have maintained 51% capital adequacy ratio. Is this good or is this bad? Let me see if you can give this answer. It's not difficult at all. They have more capital than what is required by law. So is this a good sign or is this a bad sign? Absolutely, people are giving correct answers. It is a good sign. Raman, why will it be a bad sign? No. I think majority of them have given correct answers. Jash, Sanjeev, Anirudh, Anto. Okay, 459 names I called out. Yes, these have all these have given correct answers. So having a higher adequacy ratio is always good, and that is what the company has, right? Moving on to the financials, their financial assets have grown at 60% CAGR, financial liabilities have grown at 56% CAGR, and PAT, profit after tax, has grown significantly by 123% CAGR. So all in all, financials look good, no doubt about that. The growth which has happened over the past 2-3 years, it's definitely worth taking a note of. Even their gross loan assets, loan book has increased by 63% CAGR. Okay, we are considering 3 years here, March 18, 19 and 20. For that, the loan growth CAGR is 63%. Okay. Now let us understand. One more question I'm going to ask in next 1 minute. Okay. I think many of you will be able to give this answer. This table shows you the collection efficiency. Okay. Collection efficiency means what? Were they able to recover the loans? That shows the collection efficiency. If you see here, in April 2020, the collection efficiency was 72%. This is the corona period. This is the corona peak period, May, June, 64%, then 78%. And the latest data which is given in their prospectus, their collection efficiency. So one is giving a loan and one is collecting back the EMI, okay, recovering the EMI. That is like a collection efficiency. So if you talk about latest data, that is 97.6% collection efficiency. So if collection is better, what will go down? Tell me if you can give this answer. It's a very simple answer. For any bank or NBFC, if collection improves, what will go down? Perfect. Girish has given the correct answer. Judge has given correct answer. Rajendra, Connect Sam, Harsh. Very good. 4-5 people have right away given the correct answer. If, yes, now I'm not reading out the names, but if collection efficiency increases, their NPAs decrease, and that's what exactly you can see in the next slide, that the industry NPA, average of NPAs is, latest you can see here is, anyways, even if you don't go into details, it's around 2% roughly, okay. That's the industry gross net performing asset. It's around 2%. But what about the company? The company's NPA is at 0.74% for the gross NPAs, and if I'm talking about the net NPAs, net loan assets, it's 0.51%. Okay, so gross loan assets, net loan assets, both we are talking about based on the NPA levels only. So why NPA levels are less? One more time, why NPA levels are less? Because their collection efficiency is high. Okay, I hope you have understood this point also. Going ahead with the peers, they have many peers like Aspire, Aadhar, Avas, Aptus and Home First. But out of this, only Avas Financiers are listed on the stock exchange. Is listed on the stock exchange. So if I compare Home First with Avas, okay, I get a little bit bad feeling here. Why? Let's check out. First is return on asset, followed by return on equity. Then, okay, let's go one by one. Return on assets, return on equity. Obviously, what is the thumb rule? Higher the better. Jitna return zyada utna अच्छा है ना, higher the better. So Home First is 2.7, Avas is 3.8, so Avas wins. Home First is 10.9, Avas is 12.7, again Avas is better. Net interest margin, again that's like difference between interest earned and interest spent. Home First is 5.4 and Avas is 6.4, again Avas is better. Home First is 13.2, Avas is 13.5, yield on advances, again Avas is better. Cost of borrowing, now here it's about the cost at which you borrow the funds. Here it will be lower the better, right? For Home First it is 8.7 and for Avas it is 8.4. So again here it's Home First who is at comparatively, I can say Avas is better than Home First because their cost of borrowing is comparatively lower. Well, if I talk about operating expenses, it's same. So okay, and even the leverage for Home First is a little bit more as compared to Avas. Okay, so all in all, if so there are many listed peers. There are many peers, but there is only one listed peer. And believe it or not, if I talk about all these points, in almost all, Avas is better as compared to Home Finance. Okay, but then if I check the valuation, if I were to compare it, okay. Now let us understand PE. That is what we are going to check, whether it is expensive or not. For that we have to check how is Avas placed, how are others placed. I'm not going to compare this company with HDFC. I'm not going to compare it with LIC. All these are very big companies. It's like comparing an ant with an elephant. Okay, not saying names to the company, but looking at the size of the company, we can't compare Home First with HDFC. It's way too different in size. So Avas PE ratio is 61.95. Okay, they are claiming a PE of 48. I know it is lesser than Avas, but I feel still it's kind of expensive. If I compare it with the industry average, I know again industry average will not give a clear picture because we have very big names here. So comparing it with 20 doesn't make sense. If you compare their PE ratio with 20, it's like crazy high. But I'm not going to compare it directly with 20. Even if I compare it with Avas, still it's not like very cheap. Okay, so if you ask me about the valuations, they seem to be a little bit stretched, seem to be a little bit high. IPO opening date 21st, it has opened today, closing on 25th. Then important point is when it is going to get listed. It's going to get listed on 3rd of February. That is after the budget. 2 days after the budget, it's going to get listed. We'll talk about that in a while. Okay, it's a mix of fresh issue and offer for sale. Offer for sale is again a huge chunk as compared to the fresh issue. Almost like a 3:1 ratio, almost, not exact, but offer for sale is highest. Okay, now again this is a little bit, I don't know how to react on this. Objects of the issue. It says that we are raising the funds to augment company's capital base to meet future capital requirement. So they are saying that we are raising funds to meet future capital requirement. Agreed, yes, possible. But then what is happening is that it's right now, if you check, I told you that their capital reserve adequacy ratio, I told about the capital reserve adequacy ratio, right? It's anyways very strong. It's anyways very high as compared to the requirement of the of the regulator. Still they are trying to take more and more capital through IPO. So that is why I had written that small line while preparing for the presentation. It's like Bhati Ganga mein haath dholo types is what I feel. So many IPOs are coming, chalo, all are giving good returns. Why not also we also try to list the shares of our company. Even if we have good capital right now, still let us bring in more and more capital. And the second object of the issue, they say that they want to achieve the share listing benefits on the exchange. So the objects of the issue didn't really appeal a lot to me. So I was a little bit disappointed after reading the objects of the issue. Well, one or two important points I would like to note. This is like almost the end of the presentation. But in the first quarter of 2020, the company had originally planned the IPO, but they postponed it due to pandemic. There was a pre-placement offer which happened, and it was given to Orange Club Investments, which is an affiliate of Warburg Pincus. They had sold the stake on what date? On 15th of October 2020 and 13th of January 2021. So this is like one what can I say? One part was sold on 15th of October, that is like 2-3 months ago, and one in this month itself, believe it or not, at a price of 334 rupees per share. Okay, so they have sold it to Orange Club Investments at 334 rupees per share, and what they are offering us right now, it is 517 to 518 per share. So after reading that, I was like, why? They have sold this to a private equity investor at 334 rupees, and they are offering it to us right now at 500 plus rupees. Why? So again, this was a point which again made me feel sad that this is not done here. They are getting the private equity player got it at 335 just like 2 months ago, and we are getting it at 500 plus. So we call this as the CTM, comparable transaction multiple in valuation terms. So those who have done my valuation lecture series, you might correlate this. I have taken one more example in my valuation lecture series on my website rachanaranade.com. But here again, coming back to the discussion, it's not great if I look at this data. So if you ask me, all in all, a final conclusion, financials look good, no doubt about that. Valuations seem to be a bit expensive. Comparable transaction multiple, I didn't like that, the one which I told right now. Objects of the issue didn't really hit me very positively. And one more risk point is that it's getting, I will not say it's a risk point as such, but one more point is that it is going to get listed just 2 days after the budget. So if something positively comes up in the budget, it will be good for the company. But if something negative happens in the budget, if home finance is not boosted a lot in the budget, it might backfire. So it's a little bit plus and minus, a little bit dicey for this IPO. But then the big question, the IPO has opened up today already. How has been the response on day one of the IPO? This is very interesting to see. Absolutely interesting. How is the day one subscription? I'll quickly show it to you on screen. Home First Finance subscriptions, and on day one itself, it has gotten 1.2 times, 1.26 times subscribed in the retail category, 1.28 times in the QIB category. NII category is very less, it's 0.10. But this is very interesting. 1.26 times already subscribed in retail, 1.28 already in QIB. If I talk about the anchor investors, I just read today that anchor investors have already invested 346 crores in this issue. And major anchor investors include Nomura, Fidelity, Morgan Stanley and Goldman Sachs. So anchor investors are showing interest. Could this be an indicator stating that maybe this is just a guess, okay, that maybe housing finance companies can get a boost? in the budget. If that be so, then we can expect some listing gains on this. So again, I'm telling you that financials are good. There's no problem with the financials. The only thing I felt was that valuations are a little bit stretched. But then we have to see how the budget plays its role for this company. If it comes out to be good, the company can really have a good listing, is what I believe. So let's see. I'm going to take the final decision on 25th, but as of now I feel that yes, looks good all in all, right? So that was it about the entire IPO analysis. I hope you enjoyed this first analysis which I did live on my YouTube channel. Was kind of lengthy, 25 minutes almost, but I feel you got good thought process on how the IPO is placed. Okay,